When I was writing How to Make Money in Any Market, I tried to isolate growth stocks where I could find them. I was concerned that if every growth stock I highlighted was linked to the data center, you'd end up with a portfolio that could crush you the moment the data center story went out of style in the Wall Street fashion show, which, of course, is exactly what happened. So I looked at healthcare and tried to figure out which growth stocks would come from that typical double-digit growth sales cohort. I thought about aerospace because of the insatiable demand for travel. I thought of growth retailers and how they could keep expanding. There were the much-beloved fintechs like Affirm. See that stock? Woo! Or Square, which never seems to go out of fashion, even though it's now called Block. There's Lemonade, Intuit, and I saw growth in all sorts of resource-based companies like gold and silver. These groups were the salvation of this market when the year of magical investing ended and the super speculative stocks started coming back to earth. They're still doing it. Followed by the data center plays, these were the groups that saved you. We don't talk about this migration much, but all you need to know is just to look at the stocks of Merck and Johnson & Johnson since the data center collapse, and you'll know exactly what I mean. I could easily argue that nothing good has happened to these companies that it can explain their last 10% upside, except that Meta, Microsoft, and NVIDIA have all peaked out, perhaps for now, perhaps for a long time, and the money rotated to other growth areas. These all-growth stocks have been pumped up by the collapse of the software as a service stocks, too. The much-beloved enterprise software group, which ended yesterday when the bears finally got to the one left, ServiceNow. Why is this migration so important? Because you have all these people saying that a bubble may be developing in the data center and anything connected to it. But anyone with two eyes can see that the bubble burst 2 months ago for all but Google, and that's because Google won. Now it's time to compare this situation to the dot-com collapse in 2000. Back then, there were two trends that converged. You had a huge amount of builds that the underwriters pumped out, 330 failed IPOs, and you had the retreat of the individual investor who simply vanished because of bad investments and margin calls. They own those bad IPOs. This time, you had plenty of retail investors involved, and they began to get blown out in September with the pace of the bubble burst accelerating. Most of these people should be gone soon, I say with some chagrin. They got picked off by the host of the silly double and triple leverage ETFs, a run of momentum like that was like anything we've ever seen, and the falling of the data center story itself, a combination of a lack of resources to build all things and OpenAI's inane, and irresponsible spending plans. The good news is this time is that there's a lot more money sloshing around, a lot more money indexed to the S&P 500, which means that it wasn't all destroyed like it was in 2000. That's the saving grace of this market, people. Hence the great broadening out after the bubble burst. Remember, lots of ill-informed commentators are still waiting for the bubble to burst. They don't know. It already has. That's why I'm more sanguine than most about this moment. I remember 2000. I was trading then. I remember there wasn't enough money to buoy the growth stocks. Everything collapsed. Now, though, we're seeing a great deal of strength in the very stocks that tried to save us in 2000 but failed because there wasn't enough capital around to rotate to them. Too much of it was destroyed. Or to sum up, institutional money and institutional memory fled the bubble stocks months ago and moved into all sorts of non-tech growth plays. That's the strength of this market. That's why the deflating of the Mag 7 means much less than the bears told you. It isn't 2000. It's what I call 2025, with an orderly migration back to old sustainable growth that's a beneficiary of AI, not a maker of it. I like to say there's always bull market summer. I promise to finish just for you right here, Mad Money. I'm Jim Cramer. See you tomorrow.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.